Good evening, ladies and gentlemen. This is Barry Norman on behalf of ETX, and welcome to our class on RSI, Relative Strength Index, one of the world's leading oscillating indicators for technical analysis. Now, tonight's class is sponsored by ETX, and ETX is a regulated provider, so I'm therefore required to give you what's called a risk warning. So let me read that and get it out of the way. Trading in the financial markets may result in the loss of your deposited funds. Please ensure you fully understand the risks and seek independent advice if necessary. ETX Capital provides an execution-only service, and therefore any market analysis, opinion, commentary, or other information which provided during this webinar is for educational purposes only and is not intended to be a recommendation or construed as advice. And please, as a side note, as we go through the class, we're going to be looking at some live charts to look at RSI and how they're used on the charts. Please do not think that the asset we're looking at is a recommendation. I have randomly selected charts and randomly decided what assets we'll look at, having nothing to do with inviting you or asking you to trade that asset. In fact, I haven't looked at any of these assets in many hours, so I'm not giving you up to the minute, or we're not looking at up to the second information. So please do not think of that as trading advice. It is trading education. All traders must understand that there's a high element of randomness to the markets. Therefore, they will experience both winning and losing trades while following a strategy. Different traders following the same strategy will achieve different levels of performance. Past performance is not an indicator of future results. The leverage trading product available on ETC Capital's website are not appropriate for everyone. It is possible for losses to exceed your account balance. Do not trade with funds that you cannot afford to lose, and seek advice if you do not understand the risks. Now, ETX, for those of you who are not familiar with this or joining us for an internet promotion, is a fast-growing financial services company, and we are physically based in London. We are authorized and regulated by the FCA, the Financial Conduct Authority, and our parent company, Monocore London, is a member firm of the London Stock Exchange. You can trade with us using our ETX Trader Pro platform, which is our online platform. Nothing you have to download. You just log in using your username and password, and you get all the advantages of a downloadable platform. Or if you want a more professional environment, you can download our ETX MT4 platform. Whichever one you want, both of them, you can do whatever you like. Just click on the buttons on the ETX website, and they will attach you immediately to customer support, who will help you set up any type of trading you would like to have. Now, when you have a minute, you can go to our online Trader Pro platform, our ETX Trader Pro, which is our all new online platform. It's one of the world's leading trading platforms out there, with some of the most dynamic views and a fully customizable platform. Everything on that platform can be set to fit your own trading style. Now, once every week or so, we have a class in mastering the platform, and we'll teach you how to use it all. But if you want, just sign on to the platform, and there'll be a tour set up for you, and you can just follow through the tour. It's very easy. I figured it all out myself without anybody showing me. It's very, very easy for you to figure out everything on the platform itself and use it. Now, tonight's class is being recorded. If you'd like to see a recorded version of this class after the class is over, and you need to give us about 24 hours to have it available, you can use the same link you used to come to tonight's class, and it will take you to the recorded version of the class in about 24 hours. So let's start talking about RSI, Relative Strength Index. Now, RSI is a momentum indicator developed by technical analyst Wells Weiler. And he's developed a lot of these indicators. It's well known in the technical analysis field for a lot of years. RSI was first introduced in 1978. So that's quite a long time ago. In fact, it's 22, 32, 40 years ago. And of course, in those days, it was only for the stock market. Well, Mr. Wilder has adapted it to fit Forex, commodities, and all the markets. And what we use today is the version of that developed by Wells Wilder and adjusted to fit all of the different types of markets. So without going too deep into the workings of RSI, it's primarily used as an attempt to identify overbought and oversold conditions when trading an instrument. Now, when you see a chart, RSI is dropped on the bottom of your chart. It doesn't go over top of the indicator. It is located below. It is centered on what we call a zero line, and then the RSI is calculated, and it will always come in. The calculations will always come out between 0 and 100. We can call the range between the 30 and the 70 dead man zone because they don't really tell you anything. We're looking for the indicator to come out over top of 70 or below 30. Now that's the standard interpretation. Some people use 75 and 25, some use 80 and 20. You can use whichever number you want above the 70 or below the 30. The more you push it into those numbers, the less signals you get, but the more reliability you'll have. And what we're looking for is for when the indicator bumps above the 30 or above the 70 or falls below the 30 range. We're also looking for the direction of the movement of the indicator. So there's a lot of things we want to look at and a lot of things that RSI will tell you. But first we have to understand where it all comes from so that we can understand this indicator without trading it blindly. So RSI falls into a group of indicators that we call oscillators. An oscillator is a technical tool we as traders use to give us indication of whether an instrument is overbought or oversold. Now, these terms overbought and oversold are very specific, but too many traders think overbought or oversold means buy or sell. We use these overbought and oversold extremes to see in which direction the price action will have momentum. Oscillators are typically used in conjunction with other technical analysis tools to make decisions for entering trades. There are a few oscillators like RSI, and the most popular one we know about and everybody talks about is stochastics, actually. And we should know which ones are similar because we don't want to complicate our strategy by using too many indicators and oscillators that tell us the same thing. Now, the relative strength index is a momentum oscillator that measures the speed and change of price movement. RSI oscillates between, as I said, 0 and 100. Traditionally, according to Wilder, RSI considered overbought when above 70 and oversold below 30. Signals can also be generated by looking for divergences, failure swings, and centerline crossovers. RSI can also be used to identify the general trend. So as you can see, RSI has multiple ways to interpret. Now, the calculation for RSI is very simple, okay? And you will never probably ever do a calculation. But RSI is equal to 100 minus 100 divided by 1 plus RS. And RS is the average number of days when the instrument closed up or closed down. Okay? And this number is calculated for you and placed on your charts. So to simplify the calculation explanation, RSI has been broken down into basic components. RS is the average gain or average loss. The RSI calculation is based on 14 periods, which is the default suggested by Wilder. The very first calculation for average gains and losses are the simple 14-day period moving average of the losses and the gains. The first average gain equals the sum of gains over the past 14 periods divided by 14. The first average loss is equal to the sum of the losses over the past 14 days divided by 14. The second and sequentials are based on the prior average and the current loss. So we would have the prior average plus 13 periods. Taking the prior value plus the current value is a smoothing technique similar to that used in calculating an exponentially moving average. What it does, it gives more weight to the most current prices. This also means that RSI value becomes more accurate as the calculation period extends. So let's go over to a chart and let's see how simple this is to put on our charts. So hold on, let me pop up a chart for you. Okay, so we're right now on the ETX Trader Pro platform. I've already got RSI on the charts. As you can see, it's down here below, and I made them green and red to match the candlesticks just to help us in this class. But let's go take these off the chart and do this together. So we would go over here to our tools and then locate our indicators, and we would simply go down to relative strength index. When we click on the box for the relative strength index, I'm just trying to get these off my chart instead of getting more. Okay. So, okay. Let's do this again. Okay, so we come over here to the RSI on the right-hand side, and it's going to give us just all we need to do is, okay, we have the line above and below at 30 and 70. Now you can adjust these, okay, but like I said, you can make them 75 and 25, 80 and 20, but when you do, remember you're making a deviation from Wilder's interpretation, and you have to then test it yourself to make sure you're using it correctly. You can then set the colors by just clicking on the color boxes. You want to leave it to either 14 periods or 5 periods. The standard is 14 periods. So we're going to go click on here, and we're going to change the period to 14. And we normally would always apply it to the close. Some people might want to use a high or a low or an open. Okay, the standard for all indicators is use the close. If you want to use something else, you'll have to learn how to master it yourself. So let's set the colors above. Let's make them blue so they're more noticeable for you today. Okay, and we're going to make the RSI in gold. Okay. So now we have the RSI on the bottom of our chart. Right here, we didn't have to do any calculation. Okay. Now, this is a simple process. It's easy to determine and easy to use. We've put it on. There's nothing else you have to do to build your RSI. I'm going to take you over to some other charts from TradingView that we're going to use also in class tonight to show you slightly different. It all goes on the same. The numbers calculate the same. Okay. This is an entire strategy, which is including the RSI. And see, like I said in my notes here, unfortunately, there is no RSI hold strategy. It hasn't been oversold yet at this time. So we're waiting here now for RSI to fall below the 30. Again, here, RSI has been used in our other strategies here. And we're looking at here a trend line with RSI, which we're simply connecting the tops of the indicator to see how that moves with the trend line of price. So we can see that they're moving pretty well in uniformity here. And we'll talk about how to interpret these. Again, we're looking here at, now we see RSI moving into a channel and falling down in this asset, and this is Ethereum, into a well overbought zone. We also see how the price is falling very, very hard. So we're looking for that price to reverse itself now, and we're looking for a point that it should reverse. So we've come up with the 295.73 might be a good reversal point. And we're using this with a MACD. We have our RSI. We have the channels been drawn on here. We're monitoring volume, and we see our uptrend. We have our Fibonacci's, and this has been factored into a trading schedule. Here we're looking at the NASDAQ, and we see what's called divergence. We have the trend line between the tops of the indicator moving downward while the price is moving upward. And this gives us what is known as divergence. So we get all of these applications using RSI. Now, how we interpret them is a little bit different story. So let's go back to my PowerPoint. But the first thing we want to concentrate is on how easy it is to put RSI on your charts. So let me pop you back over to the PowerPoint. Okay. So Wilder's formula normalizes RS and turns it into the oscillator that fluctuates between 0 and 100. The normalization step makes it easier to identify extremes because RSI is range bound. RSI is 0 when the average gain equals 0, assuming that the 14-period RSI and the 0 RSI value means price moved lower for all 14 periods. Where there's no gains to measure, RSI is a 100 when the average losses equal 0. This means prices moved higher for all 14 periods. So remember, we were taking, to get RS, which is we were putting a +1 divided by 1 minus 100, was the 14-day average of the gains and the 14-day average of the losses. So if you had 14 days of nothing, or 14 periods of nothing but gains, you'd have no losses. So you would have always 100. If you had, you'd always have 0. If you had 14 days of just losses with no gains, you'd always have it at 100. So that's how it would come out at the extremes. Of course, that very rarely happens, so you never have an extreme. But as you have more or less gains or losses, it moves above the 75 or below the 30. So the default look-back period for RSI is 14 periods. Now, if you're looking at a 14-day chart, it'd be 14 days. If you're looking at a 1-hour chart, it'd be 14 1 hours. Or you can increase the sensitivity or raise the decreased sensitivity. So you can change it to a 10-period RSI or a 20-period RSI. So you can, again, customize it to fit your trading strategy, but you have to test these on your own. So now let's go back to what we're looking for. RSI is considered overbought when above 70 and oversold below 30. If you change it to 80 and 20, raising overbought to 80 or lowering the period to 20 will reduce the number of overbought and oversold readings. Short-term traders sometimes use a 2-period RSI to look for overbought and readings above 80 and oversold readings above 70. So you can go back and shorten that 14-day period. That would make it more sensitive, but then you can maximize and move out your 70 to 30 to 20 and 80. So again, you can customize it very easily by making some very easy tweaks. Since RSI measures the relative strength of the underlying market, it is a technical tool that can be applied to nearly any market. However, it is commonly applied to the more liquid and larger markets like Forex, stocks, and commodities. In a downtrend, RSI can remain oversold. Okay. And this is the thing that you have to be aware of. Oversold doesn't mean to buy immediately, and overbought doesn't mean to sell immediately, because an asset can stay overbought for a period of time, and it can stay oversold for a period of time. So you want to use the center line to determine market direction. Settings can be adjusted for more or less oscillation. So when selecting the indicator for your charts, you'll be prompted to change the parameter for the RSI. I would suggest that new traders keep it at the default setting of 14 as your period. And this is the 14 referred to in the last 14 trading days. You will also see RSI at 70-30 across your indicator. Again, for new traders, this is where you should stay. Now, remember, it tells you that a trend reversal is coming close to taking place. When these trend reversals happen, we want to get into the market and ride the trend as long as possible, and preferably until the next trend reversal. So if we're in the market and we start moving into overbought or oversold conditions, we would want to exit the market. If we're looking to enter the market, it's going to give us a signal to be prepared to enter. Okay, so let's talk about how we're going to trade with RSI. RSI is used in a number of ways. There are three popular functions we talked about briefly. It's the overbought and oversold levels, RSI ranges, and divergence. Sometimes in the press and the headlines, you'll hear this stock is overbought or WXYZ is oversold. Often the speaker is referring to the stock's RSI reading. When the RSI is above 70 or 80 is often used as well, it's showing a strong run higher in prices, which may not be sustainable and therefore due for a correction. It's not saying it's going to correct, and it's not saying it's going to happen now. It's warning you that the prices have climbed too high to be sustainable and too quickly. So when the indicator is below 30, it shows a strong run lower, which may not be sustainable, and price may be due for a rally. Unfortunately, it's not as easy as buying when the indicator moves below 30 or selling when above 70. You need to confirm these. They're like tapping you in the back of the head and saying, okay, here's an alert. Let's start getting prepared, or let's start verifying this. So we want to allow price to cross below 30 and then rally back above it before buying. Let the price cross above the 70 and then back below it before selling. So we don't want to just act or react to 30. Divergence is one of the strongest ways to look at it. So here, if we're looking at this chart for Apple, and this is an old chart, so it's got nothing to do with recommending Apple to trade at the moment. So here we see the price of the asset falling. At the same time, we see the value of the indicator rising. We also see that the indicator fell below the 30 level and then has risen straight up since then, okay, giving us a very strong buy signal. Here we then go into a price rally. And here's when we see the RSI, when we talk about the center line, that's the 50. When we see the price, when we see a price rally and we see the indicator moving above the center line, which is the 50 point, that means it's moving above the oversold level into the sold level up towards the overbought level. That's telling us that we have a very strong rally, a very strong trend moving up. It's telling us at that point we might want to consider entering the market there. Okay. Again, as we continue with RSI, we start seeing divergence as the RSI indicator starts falling, but the price was continuing to go up. So in other words, the RSI was making lower highs while price was making higher highs. Now we see prices topped out and price moves into a downtrend. We see that the price is now fallen below the 50 line, the center line. Okay, it hasn't fallen below the indicator, but it's fallen below the 50 line, which would tell us we're into a strong downtrend, and we might want, this is actually giving us the clue is when we might want to enter the market. So let me just clean up my markers over here. This approach can work well in ranging markets where the price is swinging back and forth between overbought and oversold levels. Now, when a buy is triggered, a stop is placed below the recent swing low. A sell signal is used to exit long trades or initiate short trades with the stop above the recent swing high. So we see here RSI has fallen down, broken here the 30 range. Here it's broken above the 70 range. Here it's come up to the 70 range, but it hasn't been able to sustain above. Here it's fallen down to the 30 and touched and bounced off of the 30. So this is giving us some clues as to what's happening here. So here we see it giving us a sell signal, and we would have entered it as sell. Okay. We would have exited the market at this point when it touched that 30 line but wasn't able to break through. Bounce back up. And bounce down. So we can use RSI to help us to exit the market or set our stop losses also. So during trends, the RSI will usually stay contained within certain readings. And this is it. You have to use RSI regularly and on the assets you trade regularly to get an understanding of how it works with that asset. Okay. Now, during an uptrend, it typically bottoms above 30 and frequently reaches 80 plus. During a downtrend, the indicator will typically top out before 70 and frequently reaches 20 or below. This can be used to confirm trends and provide entry signals during a trend. Okay, so you're not just looking at that numeric value. You're looking to see where it traded. So you're looking to see in a downtrend, did that asset come close to the 70 but wasn't able to break it and then reach the 20 level on the other side? Okay, it's telling you a whole story, not just a numeric value. One problem with this strategy is that the RSI may not provide an exit signal, in which case a winning trade may turn into a loser. For such occasions, having a price target or another exit method is needed. Each stock moves differently, or each asset moves differently, and therefore you may have to slightly adjust range. During a downtrend, short sell if the price rallies above 65 and then drops back below. Place a stop above the recent high. Cover the short position when the asset drops below 30 and rallies back above it. The RSI is also used to spot divergence. And divergence is one of the most reliable things you can look at in any indicator. Bearish divergence is when the price is rising, but the RSI is falling. So like I showed you on the previous charts, we can see here on this chart, RSI is making lower highs while the price is making higher highs. At that point, we have divergence and we would want to consider entering the market when we got a buy or a sell signal from RSI, or you might consider it when it touched that center line, the 50 line. Now, divergence, bullish or bearish, is not a timing signal, as it can last a long time. Rather, divergence helps confirm other signals and lets traders know when a trend may almost be over. Bullish divergence is when the price is falling, but RSI is rising. It warns the price could soon move higher since selling momentum is slowing. RSI has several limitations, as all indicators do. Since the indicator is showing momentum As long as momentum remains strong or up or down, the indicator may stay in overbought or oversold territory for long periods. So remember that. Therefore, price analysis or some other confirmation is needed for reversals. RSI ranges can help confirm trends, but each asset or market will have slightly different levels. One stock may repeatedly move to 38 on pullbacks, while another may go to 33. Therefore, some adjustment is often needed for each stock, since one size fits all approach is not necessary. Okay, now that's what has to happen. I've shown you how easily it is can adjust these, but it's looking at the range. I said you don't want to stick yourself to 30-70. You don't want to just say when it pops above 30. You need to start using it regularly as part of your strategy and watch those assets. If you're one of those people that trades a million different assets, it's very hard to get that feeling of what is correct for each asset. And then you're stuck using the standard interpretations. The most basic RSI application is to use it to identify areas that are potentially overbought or oversold. Movements above 70 are interpreted as indicating overbought conditions. Conversely, movements under 30 reflect oversold conditions. The level of 50 represents neutral market momentum and corresponds with the center line in other oscillators, just like MACD. So remember that 50 line is as important to you as the 30 and the 70. In the terms of market analysis and trading signals, RSI moving above the horizontal 30 reference level is viewed as a bullish indicator, while RSI moving below the horizontal 70 level is viewed as a bearish indicator. As with other momentum indicators, overbought and oversold readings for RSI work best when prices are moving within a sideways range rather than trending up or down. So also remember that RSI is a lot more reliable and a lot easier to use in range-bound, congested sideways markets, because then they'll tell you when the market is about to move up or down. So Wilder suggests that divergence between the asset's price movement and the RSI oscillator can signal a potential reversal. The reasoning is that in these instances, directional momentum does not confirm price. A bullish divergence forms when the underlying asset makes a lower low and RSI makes a higher low. RSI diverges from the bearish price action in that it follows strengthening momentum, indicating a potential upward reversal in price. As with overbought and oversold levels, divergences are more likely to give false signals in the context of a strong trend. So remember that when the asset is trending and it's a very strong trend, you will most likely get very, very false signals from RSI. So Wilder outlines another important indicator for potential price reversals called failure swings. We mentioned these in the beginning of the class. A bullish failure swing forms when RSI moves below 30 and then rises right back above it and pulls back again, but holds above the 30. So in other words, you see the price come to 30, break 30, move back above it, come right back down to it, and doesn't break through it again. That's considered a failure swing. The failure swing is complete when RSI breaks its recent highs. This breakout is interpreted as a bullish signal. So remember, when it's down at the 30 level, breaks that 30 level, falls back into that 30 level, and then stays along it but can't break through it again. That is a bullish signal. Bearish is the exact opposite. So bearish failure swing. In this instance, RSI moved above 70. And let me highlight this for you. You see it's circled in gold here. But the RSI moved above the 70 level, which is right here. Then fell back below it, bounced off the 50, was not able to come back up to that 70 level again, and fell back down. That's a failure, okay, because it wasn't able to move above the 70 and stay. It moved for a second above it, but wasn't able to sustain. So what happens, RSI moved above the 70 into overbought conditions here. It then moved back below the 70 almost immediately. And then it moves back below 70 and then reverses upward, okay, but remains below the 70 level. It's not able to get back up and break through that 70 level. In this case, the 6250 level, let me get my markers up here so you can see it, which is right here on the red line, generated a bearish signal. So this was telling us a sell signal at this point to sell. So we see it steadily moving upward as the trend is moving upward. It breaks above the 70, falls right down below the 70 while the trend is still moving, bounces up, it comes back up towards that 70 level, but it is not able to break it. So it failed and fell back below. Okay. When it fell below the previous low, which was right here, okay, that gives us it generates for us a signal or a bearish signal to enter the market, to tell us this uptrend was over and we moved into the downtrend. So as mentioned in the above interpretation of RSI, it is more reliable indicator in ranging markets and can give misleading signals in a trending market. However, a modified interpretation of RSI can be used in a trending market. For example, during a strong uptrend, RSI might move only between the 40 to 80. In such case, RSI falling to a 40 signal is potentially a bullish reversal, and the below 80 level can be viewed as an overbought area where it's not safe to initiate long positions. So this is why you have to use RSI, get to know it, understand it, and use it on a limited amount of assets that you get to understand what levels are important to that asset. And remember, if you're a beginner, use it in ranging markets only. Don't get involved in all the other complicated stuff. And once you start mastering it, you'll start seeing these areas. Like here, you see an excellent failure swing. Trend lines can be used on the RSI oscillator itself in the same way as on price charts, by connecting higher lows in an uptrend or lower lows in a downtrend of the indicator. Breakouts above or below these trend lines can serve as to indicate a potential reversal in price. When traders first learn about RSI and other indicators, they tend to gravitate to overbought and oversold values. While these are intuitive points to enter in the market on retracements, this can be counterproductive in strong trending environments. RSI is considered a momentum oscillator, and this means extended periods can keep RSI overbought or oversold for long periods of time. So when we can see prime examples using RSI in the pound 8-hour chart, even though RSI dropped below a reading of 30 on July 27th, prices continued to decline as much as 402 pips. Now we see the decline here, RSI stay below, but we can also see the increase. And this is why we want to use that 50 line as an indicator also, because it maintained both its bearish and bullish momentum for a long time. So the 50 line or the center line can be a very important shift element for you. So watch that center line. All oscillators have a center line, and more often than not, they become a forgotten backdrop compared to the indicator itself. RSI is no different. A center line found in the middle of the range at a reading of 50. Technical traders use the center line to show shifts in the trend. If RSI is above 50, momentum is considered up, and traders can look for opportunities to buy the market. A drop below 50 would indicate the development of a new bearish downtrend. So watch the center line at all times. It can become more important than that 30 and 70, or that 40 and 60, or the 70, the 80-20 line. RSI is popular because it has multiple uses. It is used to find entry and exit signals based on overbought and oversold readings and trending ranges, and can help spot or confirm reversals via divergence. Like any other technical tool, though, the RSI is prone to provide false signals. Price analysis is still needed to determine if a trend is present, and then important RSI levels identified for that particular security. And remember, that particular security. So on that note, I'm going to say goodbye to everybody. Thank you very much for joining us. I hope we gave you some general introduction to RSI, and you can start learning how to use it and move it into your trading strategy. Thank you very much, and thank you for supporting ETX. Good night now.